Okay, so now let's talk about these federal tax credits. How do we get them? Well, federal tax credits up until now have been something that you get when you file your tax return at the end of the year or in April of the following year. If you're entitled to tax credits, you get it back at tax time. But they realized in the Affordable Care Act that's not going to work for health insurance because the whole idea is to make the premiums affordable now. So they actually created something called an advanced premium tax credit, where they calculate what your estimated credit will be for the year, and they advance it each month, not to you, but to the insurance company. So, for example, if it turns out that you're entitled to half of your premium being paid, then every month when you pay your premium, you'll just pay half, and the insurance company will collect the other half from the government. And so that's why they've made the advanced premium tax credit so that you don't have to advance the premium and pay the full premium every month and wait to get reimbursed. And of course, this is based on your estimated modified adjusted gross income for the current year. Now let's talk about that. There's a couple things to consider. For most people, that is adjusted gross income, which you'll find on line 11 of your most recent 1040 form. Okay. But there are modifications, things that are countable or not countable, that can change the adjusted gross income. That's something you can discuss with us or with your accountant, your tax person, or your CPA. Now, I said before that there is a minimum amount of modified adjusted gross income that's required in order to qualify. If you have low income or no income, then the only benefit that they'll give you is Medi-Cal here in California, which is essentially our version of the federal Medicaid program. And it is based on the federal poverty level. Here in California, it's 138% of the federal poverty level. And that's based on household size. And when we talk about household size, we're not talking about who's living under the roof. We're talking about how you file your tax return. Are you a single taxpayer? Are you married filing jointly? Do you have children? Are you a single person with children? And so that's how they determine the size of the household. Now, for a single person, at this particular time, here we are in 2023, the 138% level is $20,121. For a household of two, it's $27,214. Household of three, $34,307. Household of four, $41,400. Those are the minimum thresholds. And it's important to know that those minimum thresholds are for adults, meaning from age 19 and beyond. They have something else known as the Children's Health Insurance Plan, CHIP. And with the Children's Health Insurance Plan, the threshold is different. Instead of 138%, it is 266%. So if you have children, it's possible that the adults could qualify for Covered California and the federal tax credits, but the children have to be in Medi-Cal. And that 266% level, of course, is much higher. For a family of four, that would be $79,800. Now, don't worry. Sometimes people are fine if they're in Covered California and the children are in Medi-Cal. If that's a concern for you, it is possible for people to purchase, for the adults to purchase their coverage through Covered California, and then to purchase coverage for the children with a private insurance company directly and not rely on Medi-Cal, not rely on Covered California. That's entirely up to you. But this is, in terms of the amount of the tax credit, it is a sliding scale. The higher your income, the lower the subsidy will be. And because premiums are higher for older individuals, the tax credits are going to be more generous the older we are. It's easier for us to obtain tax credits when we're older than we are younger. That's because at the top end, let's say at age when we're in our 60s, premiums can be easily 3 times as much as they are for a person in their 20s. So the person who is in their 20s, their premium is already naturally lower. So therefore, they're going to be less likely to qualify for the subsidy. Whereas a person who's well on in their 50s and 60s will be more likely to qualify for tax credits. There used to be a cutoff at the 400% federal poverty level. We called that the cliff. If you made $1 more, you don't get anything. But that no longer exists, at least for the time being. In 2021, they had the American Rescue Plan Act, which removed the cliff through 2024 and 2025. So for the time being, we don't have to worry about having our subsidy taken away because we are above the 400% federal poverty level. But again, it is sliding scale. So the higher you go on your income, the less subsidy you qualify for. And ultimately, with higher income, there may not be subsidy at all. One thing that we certainly can do is we can help determine whether or not you'll qualify for those subsidies. And that's what we're here to help you with. Look forward to doing that.